Okay, just looking at the interim results for 2014, I'm going to touch on some highlights. Our financial results are ahead of market guidance. Our distribution growth is 36.4 cents. That is in percentage terms 8% up on last year, same period. Our distributable income exceeds 1 billion rand for the period. That's a first for Redefine for the first half. In rand terms, our recurring distributable income has grown by just under 16%. That is a very pleasing outcome in that we haven't been reliant upon any non-recurring income to make our distribution target. During the period, we had an accelerated book build whereby we raised 1.3 billion rand at an attractive forward yield. That was during December last year. Our active portfolio margins up 1.2% to 80.7%, and I'll go into some detail on that in a short while. Our group assets are now 51.3 billion rand, and that's a first for Redefine in that we have breached the 50 billion rand mark. Total tangible assets have grown by 2.5 billion rand to 46 billion rand, and our international property assets are up just under 2 billion rand to 6.6 billion rand. Our net asset value is up 51 cents to 9.22 per linked unit, and that represents a premium, the price of Redefine represents a premium of about 8% to that net asset value figure. We've introduced for the first time an election to reinvest the cash distribution in return for Redefine shares, and our average cost of Redefine's debt is reduced by 20 basis points to 7.8%. Interest on Redefine's debt at 28 February is fixed at 81.2%. That's up from our target in the past of 65%. Just looking at our distributable income for the half year, you'll see that our actual distributable income is 1.1 billion rand. In cents per linked unit, that's up 8%. And as you can see from the slide, there is no non-recurring fee income in 2014. Just looking at the first half trading results in summary, I've built a summary here showing some tailwinds and headwinds, taking last period's distributable income of 987 million and showing you the ups and the downs to this year's total distributable income of 1.1 billion. So in total terms, the tailwinds are 306 million rand and the headwinds total 177 million rand. Just looking at the breakdown of each, you'll see under the tailwinds, we have got a gain of 70 million rand, which has been enabled through holding our property portfolio costs at last year's levels. So all income that was received on an incremental basis in 2014 have dropped to the bottom line. That's 70 million rand, as I said. We've had property acquisitions coming through in a full period in 2014, as opposed to not being there last year. You'll see that 62 million rand in total. Two main culprits come to mind: East Rand Mall and Elleren's Distribution Centre in Cato Ridge make up the bulk of that 62 million rand. We've got net gains from the Fountainhead investment of 69 million rand. In effect, what we have here is a total gain from Fountainhead of about 200 million rand, offset by the disposal of the Hyprop units, which were disposed of during the course of 2013. In terms of the exchange rate gains from Redefine International, we had a benefit of 25 million rand. And then from investing in Cromwell during the course of 2013, there's a full period benefit of 61 million rand from Cromwell. There is a further 19 million rand benefit from the internalisation of Redefine International Fund Managers, whereby we received Redefine International units for our shares. That's 19 million rand. Looking at headwinds, you'll see that in the prior period we had non-recurring fee income of about 18 million rand, but in total terms it's 21 million rand with a few other elements therein. There's lower trading activity from speculative property activities. That's 1 million rand down. There's higher administration costs of 14 million rand. There's a couple of numbers within that, the biggest one being the share scheme of 6 million rand that came through in this period, introduced during the second half of last year, extra marketing costs and some upskilling in our retail and development divisions accounting for the balance. In terms of our UK REIT withholding tax, we incurred 5 million rand there. Unfortunately, that's leakage that's come through in the second quarter of 2014, and that's as a result of Redefine International now converting to a UK REIT. In terms of finance costs, we carry an extra cost of 135 million rand, and that's driven mainly from higher borrowing costs, higher debt that has come through as a result of the acquisitions during the course of 2013. Looking then at our simplified statement of financial position, I've taken the financial position at 28 February, compared it to last year, and I've broken up parts of the balance sheet into property assets to provide you with the opportunity to see where the constituent parts all reside within the statement of financial position. As you can see, in 2014, we've got total property assets of 44.5 billion rand and total assets of 51.3 billion rand. In terms of funding, I've just grouped together all the elements of the balance sheet that relate to funding, and against those total assets of 51.3 billion rand, you'll see that we have total funding of 48.5 billion rand in 2014. Now, if I compare that on a consistent basis to the prior period, you'll see, to 31 August 2013, you'll see that there's been a net growth in property assets of just under 2 billion rand, with the bulk of it being focused on our international operations. That's under the global column. And if I look 1 year back to 28 February 2013, you see a growth in property assets of 14.5 billion rand, with the bulk of it being consolidation of Fountainhead, 11.6 billion rand, and our international expansion of 4.4 billion rand. Looking at our growth in net asset value, we're very pleased that we've increased our NAV by 51.1 cents, and that's a premium of our price to the NAV of about just over 8%. If you have a look at the parts giving rise to the growth, you can net off the capital raised and the dilution arising from those additional units, and in effect, the revaluation of the asset base of 48.7 cents gives rise to the net growth of 51.1 cents per linked unit. Looking at capital allocations and returns, you'll see that in terms of distribution contributors, Redefine comprises the bulk. Just under 62% of our total distribution comes from Redefine itself. About 19% comes from Fountainhead. So locally, we're about 80% of total distribution, and the balance comes from our international investments. As you can see, Redefine International is about 11%, Cromwell's about 7%, and so it carries on. Looking then just at our NAV composition, you'll see that Redefine is about 58% of that base, and Fountainhead is about 20.1% of that base. So if you group together Fountainhead and Redefine, locally we are probably about 85% of the total, and about 15% is international. So you'll see that international is actually a more efficient investment than the local components. And I've given you a return on equity on the side there where you can see just that. Just in terms of distributable income statement for the half year 28 February, we've already touched on all the lines from below, from Fountainhead distributable income onwards, but the one I want to expand upon is the top line, which is the net operating income from investment properties. If you have a look at our active portfolio income analysis, you'll see that revenue has grown about 6%, and I'll go into a lot more detail shortly, but the active portfolio costs are essentially flat on last year, and that's given rise to the growth of 7.3% in the property income from the active portfolio. I've already spoken about income from acquired properties and that growth, and what's very pleasing, and I'll also touch on it in a short while, is the active portfolio margin, where you'll see a 1.2% improvement from 79.5% in 2013 to 80.7% this year. Looking at the portfolio revenue performance, you'll see that offices and retail have essentially held up quite well in these difficult conditions. You'll see that vacancies and new lets for both offices and retail have essentially offset one another. The pressure point has been in industrial, where during the second half of last year we had 2 major vacates, and that's impacted significantly on income in this half. If you have a look there, you'll see that vacancies have given rise in the industrial portfolio to a 12 million rand deficit, and we've had new lets of about 4 million rand. That has put pressure on the growth on the prior period, as you can see, whereby industrial has only grown by 3.7% on the prior period. But overall, the reasonable growth from offices and retail have held growth on an overall basis to just under 6%. In terms of portfolio costs, I've provided you with a reconciliation here from last year to this year, and you can see that the game changer for us has been the internalisation of electricity recoveries. We've had a net gain of 34 million rand this period, which has offset all the other growths in the cost lines. I'll just touch on municipal charges. You'll see there's a 15 million rand increase. 10 million rand of that 15 million rand increase was as a result of a release of an over-accrual in the prior period, and the balance has been from very substantial rates and taxes increases, which average out just under 30%. All the other cost lines have been reasonably well controlled and are all essentially driven by activity. In terms of bad debts, you'll see that there is quite a substantial rise in percentage terms, in monetary terms quite low, but I will discuss it in a bit more detail shortly. We'll show you that although it's a significant increase in relation to prior periods, it's probably not an unreasonable number. Just looking then at some ratios below, going back to 2013, you'll see that we've actually worked very hard to contain operating costs as a percentage of active property income. 2010 it was 20%, and we're down to 17% in this period, and so it carries on. And as I said earlier on, electricity recoveries, you'll see from a net under recovery last year of 76%, we are now in an over recovered position of 110%, which has been a huge benefit this year in terms of managing to contain costs. In terms of efficiency, if you have a look at how every 100 rand we receive in property revenue converts into our profit or our profit margin, you'll see that the electricity charges net of recoveries has been the driver of the 1.2% improvement, despite pressure points on municipal charges net of recoveries, and also in other areas such as repairs and maintenance and property management for that matter. If you have a look at bad debts, which I mentioned earlier, as a percentage of revenue at 0.5%, it's by no means an unreasonable percentage. And if you look at it in relation to 2012 and before that, you'll see that it is in line with prior periods. 2013, we had a reasonably good year on the bad debt front, as you can see. In terms of our funding profile, at the end of February, you'll see that we had debt of 17.9 billion rand, with the bulk of that being Redefine's debt, as you can see, just under 14 billion rand, with Fountainhead making up 3.1. And then funding our international expansion in Australia, you'll see that we raised just under 800 million rand. To the right of the picture in the center, you'll see a slide there where we compare the repo rate and the 5-year swap going back to 2000. And the reason for me including this graph is just to illustrate that prior to the global financial crisis, which occurred around about 2007, 2008, there was a give and take relationship between the repo rate and the 5-year swap, where you can see that it was a reasonable gamble to enter into 5-year swaps to manage your interest rates on a fixed basis. Since then, it's been a one-way bet for the counterparties on the swap rates, as you can see, where they have consistently exceeded the repo rate since the GFC. This does support our view that whilst the interest rates were very low, that we were quite aggressive in terms of fixing our interest rates at 65%. We've since revised our policy, now that we are looking at an upward interest rate cycle, to be fixing our interest rates at a minimum of 75%. And you'll see in this period, we are sitting at 81.2%. Just looking at the other key debt statistics, you'll see that the loan-to-value ratio is just under 38%. Our debt capital market funding is just under 19%, and over time we'll like to increase that to 30%. Our average term of debt is just under 3 years. Our percentage of debt secured is 70%. Our percentage of assets secured is 66%. I think what is very important is to note that the equity headroom on our total asset base, and these are property assets, is 24.3 billion rand. So for the unsecured lender, there is substantial equity against which they can secure or have comfort against their exposure. In terms of weighted average cost of borrowings, you'll see that we averaged a cost of 7.8%, and I'll touch in a short while a bit more on that point in terms of cost of funding in total terms. And in terms of our fixes, you'll see that we're just under 4 years fixed, and we have undrawn debt facilities that are available on demand of 2.4 billion rand, which are readily accessible. Just looking at our cost of capital for the half year ended 28 February, at the top of the slide you'll see a graph where we have just gone back to 2011 and compared the 5-year swap rate to the R1 at 6, that's a government bond, which is a 10-year bond, and to the Redefine yield. And you'll see there that there's an almost perfect correlation between the three. Now what this tells me is, one, our swap curve, which we use to fix our long-term interest rates, and Redefine share price, which is a driver of our equity funding, are both linked to government bond yields. And whichever way you look at it, we get back to the same answer. So looking at the bottom of the page, you'll see that our average cost of debt at 7.8% is comprised of 3 components. One, the floating rate, that's the average JIBAR rate of 5.3%, our average bank margin of 1.6%, and then the cost of funding, or fixing the funding rather, at 0.9%. The equity that we've raised during the course of 2014, you'll see, came in at a forward rate of 7.7%, which averages out, as you can see, at a very similar percentage to the average cost of debt, which is supported by my slide above. In terms of unit holder profile, you'll see that our top 10 beneficial unit holders at the end of March total, in percentage terms, 38% of the total units in issue. And what is interesting to note is that there are no international investors in the top 10 list. When we last presented the slide, the second largest investor was an international one. They've all dropped off the list. But what is quite interesting to note is that the international ownership, although they're no longer in the top 10, they have by no means disappeared. If you have a look at 2014 versus 2013, you'll see that we are, in percentage terms, basically at the same level that we were when we last reported. So there has been fragmentation of the international shareholding, but by no means have they disappeared. In terms of Redefine and asset class returns, as you can see, Redefine, going back a year, has had quite a run, but has essentially tracked what has happened in the property sector, and as you can see, has had quite a difficult patch, especially since May, after Bernanke's announcement on the easing or the tapering of quantitative easing. What is interesting is that since Redefine has become a REIT, our daily trade is significantly up. Our daily trade for this half versus last year's first half, we're up almost 37%. And if you look in daily terms, we are currently averaging about 6 million units per day for 2014, which if you annualize is approximately 50% of our total shares in issue that get traded on an annual basis. Just in terms of the value created by Redefine in cash terms, if you have a look at the side on the left, the cash value created, I just need to remind you that Redefine is a cash business. Whatever we do is all centered around generating cash, and positive cash flow. If you have a look in total terms for the 6 months, we generated just over 2 billion rand, and I'll give you a breakdown of that, as you can see. But on the right-hand side, you can look at how we distribute that value. And the bulk of it, 51%, goes to unit holders in terms of their cash distribution. This is now assuming that no one takes up the election to receive units instead of cash. And then that's followed by our debt funders. They receive almost 40% of the cash that we generate in terms of interest payments. The balance goes to employees, 4.5%, municipal authorities, just under 2%, minorities, just under 3%, and the balance is tax. Tax is very low, and that is really due to the fact that Redefine now is a corporate REIT, and all distributions flow through to investors who are subject to taxation. Thank you.